Hello everyone, with this video I'm going to build my 2026 stock portfolio. This means that I'm going to use my strategy and show you guys what I usually do when I start to invest on new companies. I build a portfolio from zero. The strategy that I apply is of course value investing. For people that doesn't know, value investing is when you are trying to figure out if there are any businesses in the markets that are undervalued. For undervalued, we means that they are undervalued compared to their free cash flow, compared to their peers, and compared to the markets itself. This is a really huge and hard work, and this is because it's really difficult to say that investing is science. Investing is a mix between science and art. For this reason, in this video I'm going to show only the main and most important things that I try to look for, but there are a lot of things that I will do that I will not show on camera because otherwise the video will be long 55 hours, I don't know. But if you want to know more about specific part, just write me on the comments and I will try to create a new video just to answer those comments. So before we go on, I just want to say that this strategy is based on my academic background, so that I have a background in economics and finance, and then I'm still working on. So it's still work in progress because investing is a journey and I'm still trying to upgrade it over time based also on my personal preference. What I suggest you is of course to read a lot. There are a lot of good books that talks about investing, especially for beginners, and I will write down on this YouTube video all the kind of books that I really find useful. Okay, before we start, a quick disclaimer. This video shows my personal equity portfolio and my own analysis. This is not investment advice and this is not a recommendation to buy or sell any kind of security. Investing involves risk and everyone should do their own research or consult a professional. I am a financial advisor, but this content is for educational purpose only. Okay, the first thing that I do is, of course, stock screening. The terminal that I use is Ticker Terminal. It's cheap, it's good. You can try it out with my referral code that you can find this bio of this YouTube video. Try it out, let me know what you think about. I really like it. So there are a lot of different stock screeners that I use. I just don't use one and only because there are different types of stocks and businesses that I look for to create my optimal portfolio for me. The first one is for stability and growth of the business, but it's something that I use to actually export data to Excel and then work on them. And this is to inspiration to TSI, that is the Swedish investor, and he's a really good investor and YouTuber. You can check his videos, he's really good. Then I go with the try to find PA ratio below of 7. This is really hard, of course, because also nowadays markets are really high PA ratio. For people that doesn't know what is PA ratio, basically is the fundamental of value investing, but it's much more complicated than that, and I'm going to talk about that in other videos. So just make sure to subscribe to the channel and you can know more about those things. Basically, their core concept is that I'm looking for businesses that are sustainable. For sustainability, I mean that they have really low long-term debt or even zero long-term debt. They have really high return earnings, they have really stable growth, and they are operating in the market for years. I don't want companies that work in general for every stock screener that work in the financial and the real estate sector, basically because it's something that I don't understand completely, so I just avoid them. Also because major crises are caused from those two sectors, so I want to avoid those. As you can see, the main aspects that I'm looking for are revenues, gross profit margins, dividend. I want dividend. I don't want companies that doesn't pay dividend or doesn't have a payout ratio, sorry. And another thing that I do for every single stock screener that I have is the global region. I want them to be in Europe and US. This is because I'm a European and in Europe is better for tax efficiency. If the stock is in Italy, it's even better because it's more tax efficient. If it is in the US, I have to understand if it is actually good, tax efficient in the long term. What I'm trying to do is trying to find out if I can find stocks that I can buy and hold forever. That is the basic concept, but we are going to check if it is actually possible nowadays or not. Another screener that I have is a growth screener. This screener is based more on less years. So I'm looking for companies that have a good growth, but they are making a good growth from the past 2 or 3 years maximum. This is also something a bit higher risk because the company maybe doesn't have a long-term stability or long-term growth. I'm going to check company that has a lot of up and downs. I want to see if there is something that I can give them some possibilities as an investor. And then the last one is the long-term stability. This is really generical, just want to check out some more businesses that are not taking consideration from my previous stocks screeners, and then I'm going to select few of those. So for example, let's start to flash the screen of this stock screener, and as you can see, those are all the stocks that the screener find out for me. Now, there are not a lot. As you can see, there are really, really few stocks because I'm really selective with my stock screener. And what I do is sort them based on the market cap, and I check the stocks that have less market cap. I like stock that have a small cap or mid cap. The lower last market capitalization is this one, so I'm going to click on it. And Ticker is really good on that because it gives us a lot of good information. Okay, so in this case, I found Hagar HF. I don't know the pronunciation if it is right or not. I'm going just to set the USD dollar to understand a bit more. What I do first is to check what the company is, what I'm looking at. Hagar AH operates retail stores in Iceland, and I call this kind of company all-in-one company because they do everything possible to sell and give services to B2C and B2B, as I can see. So I like those kind of businesses because they usually have a good cash flow, but we have to check those later. Now, the last peer ratio is 18, and this is not a bad peer ratio. I usually look for something like lower of 15 peer ratio, but it's really hard to find good and cheap companies on the market. By the way, I'm doing this video on the 18th of January, so the markets nowadays are really, really high. And when I say markets, of course, I mean the equity market. Another interesting aspect of this company, of this stock, is that the beta, the last 5-year beta, is negative 0.13. This means that the beta is negative, then the stock price tends to move opposite to the market. So this is really good. Since also the markets are really high, this is something that I don't dislike, especially when I want to build a balanced stock portfolio at the end. Overall, the last year, the stock went really well. He had a 31% return, price return over the last year. And if I go to check the last 5 years, we're talking even about a price return of 199%. This is really good. This is something that I like. And as we can see, the company is operating in the market since 2012 at least. This is the data that Ticker is showing me right now. But as we can see here, we can see that Hagar, it was incorporated in 2003. This means that they operate since 2003 at least on the market, and this is really good. It's something that I like to see. So the next thing that I check is the dividend yield. This time, Ticker doesn't tell me. I don't know if it is because maybe they just doesn't give any kind of dividend, or because it's just a problem with ticker terminal, but we are going to find out on the financials. So on the financial, we have income statement, balance sheet, cash flow statement, ratio, and segments. If you want to know more about those aspects, I don't know what to tell you. There are a lot of different good books on that. I'm just going to apply my own strategy that I created over years, and I think that it's really good for me. So just let me know what you think about. What I do here is trying to get much data as possible. There are different type of data set, main ticker data or secondary data or Morningstar. The first thing that I do is, of course, checking the total revenues, and we can see a good growth. That's good and stable growth overall, especially the last 6 years. It has a really good growth. This is something that I just note on my notebook, and then I go to check on some annual paper why this company had this good growth on the last years. So I go on with the gross margin, and even though if the company had a really good revenue growth over years, we cannot say that it had a good and stable gross margin. This is an anomaly, especially on 2023. So I'm going to note down this 2023 and check on the annual paper of that year if the company had said something about that. Then what I do next is just go into the net income and check how much the company is making based on their total revenue and gross margins. So based on the total revenues, the net income margin should be around the 4.5%, I think, and that's good. This is something that I was expecting to. Now, another really important aspect that I want to check on the income statement is the dividend per share. The company didn't pay at all dividend. And this is not something that I like, because if the company decided for 1 year to not pay dividend, it could decide easily the next year to not pay a dividend. So I want to see a constant dividend payment, even though maybe it's not always a good percent, but just I want to see that the company is able to pay dividend. For people that doesn't know, payout ratio basically means how much of the net income is going to the investor through dividends. So it's a really useful data that and metric that we have to take in consideration. Just I want just to say one thing more is that all I do here is the first approach. Everything that I will do later is on Excel. So this is just the first approach that I do for each stock, for each of my screener. Going on the balance sheet instead, I usually never check the assets at all. But just to tell you, most of the investors check the account receivable, cash and equivalents, and net property, plant and equipment. Each aspect of the assets of the balance sheets are important for what we are looking for on this business, but I usually go and check the assets of the balance sheets just at the end when I'm sure that I'm going to pick out this company for my portfolio. I check the annual report, and when I understood completely what the company does, I go and check the assets of the balance sheet. I never does it before. Right now, as I said before, I'm going just to check the sustainability of the business and how is the growth going, and if this growth is sustainable compared to the price. So I'm going to check for sure the long-term debt. I remember that the net income, is 7 million, and the long-term debt is around 70 million. So this means that this company is using leverage right now, but one of my rule is that I allow that a company that I own to use leverage if that company can repay out the long-term debt with the last 5 years of net income. This company is still using much more leverage, much more debt that it used the last years, and this is okay. I have to check more about on the annual report and what they say about that. I'm really trying to go really fast because there are a lot of things to cover, and I don't want to make a really too long video. So I will talk a lot more about those topics if you want in other videos, but just to let you know, there are a lot of different aspects to talk about. One of the thing that I have to check, and I really need to know that it's going good, are the return earnings. Basically, return earnings is how much the company is putting aside so that maybe the investor like us are in a safe zone if everything goes wrong. And as we can see, it's a good number, it's going good. The company has a long-term view and long-term stability based on the return earnings. Now, let's talk about the book value. That it's over here, book value per share, and it's a really high book value. So if I'm right, the book value is in factly 3.27. This means that the company is valued higher than their net asset value, and maybe the market is expecting higher growth or some kind of intangible value that I'm not looking at right now. For sure, this company have huge warehouses, and what I want to check now are the capital expenditures. They doesn't have huge capital expenditure. I think that most of the capital is it's for this reason because they can lower the capital expenditure, especially for particular type of equipment that they're using. They just rent them and they put them on the balance sheet instead of the cash flow statement. So for this reason, there are lower capital expenditure than expected. In fact, the free cash flow, is really huge, and this is because the capital expenditure are not so high. And this company knows that most of investors check for cash flow nowadays, so they are trying to lower the capital expenditure as much as possible. And the free cash flow is really good, and we have also a really good change overall. But of course, this is just the first thing that I do. The next thing is to check the average of each of the data that I just talked about and compare them to the historical average data, and also doing and conduct a competitor analysis to check how this company is going compared to their competitors. I do this because each sector is unique, each company is unique, to take in consideration what is the good, for example, return on asset for this company that operates in this sector. Just take simply another company that operates in this sector that is the competitor of this company and check how it's going. Another example that I conduct the competitor analysis also for taking in consideration the inventory turnover. I want to check how the inventory turnover is going for all the companies that are working on the same sector and how trustful are those data, because on inventory turnover of 11.19, it's really damn good. And I just want to be sure that this is a good data compared to their competitors, or it's just a good data compared to this single company. This is another reason why I really like Ticker, because it shows us also different segments. And when we are talking about segments, we are also talking about where their revenue, income, assets are from or are used for. And this is really good because this company operates in different segments. So as you can see, this is a really useful data, but you can check those also directly on the annual report. And also they give us the geographic segments. So when we talk about growth, we want to know, and since this is basically more of a overall a local business that work on the specific and geographic area, I want to know where this business is working right now. It seems like that it's working merely in Iceland, nothing more, nothing less. And this is good and bad at the same point, because good because it means that the company can upgrade and can grow a lot through different region, countries, but we have to check those on the annual report too. And this is it. This is what I basically do just for the first approach. Now I'm going to export all this data and get ready to work on them. But before that, I want to check if all that if is worth it. And basically what I do, I go to check the ownership. Why I do that? Because stocks are on a market, of course, a regulated market, but there is the principle of supply and demand. And if I see a company or a fund that I don't like owns majority of the actually business is something that I don't like. So what I see here is that there are a lot of Iceland individuals, that investors that own this company. The first one is Gildi with 16.43%. As I can see, I don't know that. I have to check that, but on my first opinion, it seems like that he is a fund from Iceland that work mainly and invest mainly on Iceland. That's good. That's something that I like because it means there is long-term view. The Vanguard Group is really good. It's really well known also for their ETF products, and I see that they own 3.12%. I don't really care if they like change negative their ownership. if it's like a really slow and low change, because maybe this is something that the funds or the investor does, their needs of portfolio, a better portfolio management. So I don't care about that at all. What I care is this kind of data. For example, here we have a minus 21%, and here we have a minus 54%. And these are data that I really don't like a lot, because maybe, and I say just maybe, there could be a better choice than this one on the same sector. So this is another reason why competitor analysis is really important. Okay, so this is basically what I do for each company on my global screener. Now I did this one for Hagar, but I go now to check all these other company, also Alibaba, even though it has a really high P ratio for sure. Let me check really fast. Yeah, it has a P ratio of almost 23%. But yeah, I'm going to do that for every single possible company. Even though we are talking about Nvidia, I do that. I don't care. I always check everything that comes out from my stock screener. And of course, from this stock screener, from this one, from this one, from this one. And then when I choose the best company, I just take them to the next level, that is working on Excel and then doing my investor checklist. Okay, so just to tell you what I'm doing right now is that I'm going to write down this company on my Excel, as you can see, because I like it. Write the ticket down, write what currency we're talking about, because currency is a risk also for your portfolio, so you have to know what kind of currency you are buying when you are buying these kind of companies. And then before putting on scores, I have to fill these tables. When the table is filled with all the company that I choose based on my stock screener, then I go directly to the Excel and work for each company and analyze each finance data of each company under a quantitative point of view. And then I pass to the qualitative point of view through, first of all, the annual report and checking all my investor checklists. And personally, my investor checklist is something that I built over years, so I will show you later. Okay, as you can see, I found out 20 stocks that have good potential through my stock screeners, and they are really good in my opinion, but I don't want all of them. So what I do now is going on a more deep analysis through a quantitative and qualitative analysis. I will give them a score based on the quantitative and qualitative analysis that I will conduct, and then I will compare it with the analyst score. And then I will choose, based on my score, the best stocks to pick for my portfolio. The number of the stocks that I pick is really variable, depends a lot from the result of these analyses that I will conduct. Now, to go more in depth, as you can see, this is the analysis in general that I do. I conduct. We have a fundamental analysis and a qualitative analysis. So for fundamental analysis, I will download for each stock all the financial data that I have and try to beat my benchmark that I create for each one. I wrote each benchmark based on an analysis that I conduct before doing in this video, and is the market temperature analysis. And my objective is, of course, try to beat these benchmarks through an analysis of the financial data, and I will compare a lot with some of those with historical data and the actual data that the companies have. And I will give a score from 0 to 2, where 0 is worst and 2 is the best case scenario. And then I will give an explanation about what I wrote down and why I did that. Regarding qualitative analysis, this is the best part of investing. Here is where investing is no more a science, but is more an art. And what I do is usually checking the annual report, at least 3-year annual report for each stock that I got, and going to give also here a score. So this analysis that I created through my academical knowledge, and also all the plus 100 books that I read about financials and investing. I think it's really good, but of course it's not optimal, it's not efficient. I have to work a lot on that, and that's why investing is a journey, because you start with something, but you have to work on it through your journey. And I really suggest to you to start with your own strategy and to create your own analysis based on your personal preference. When I finish this for each stock, then I will go and do the same for each competitor of each stock. So I will compare also the data with the competitor analysis. This is really a big work, so for sure it's going to take me a while. When I finish, I will continue with the video. Okay, 2 days passed. Today is 20th of January, and as you can see, this analysis takes a lot of time. What I found out are undervalued company, of course, and I will take in consideration from Build a Beer till Puilo for my portfolio creation. The one that are not so undervalued compared to the others and based on my analysis are Logis Integral, Williams Sonoma, Dick Sporting's Good, Lululemon Athletica, and Ryanair Holdings with Build a Beer. They are not so undervalued because sometimes it's not so undervalued compared to the free cash flow, and sometimes they are undervalued compared to the peers, but in general, I don't feel to say that they are undervalued completely. For the rest, they are not really known stocks names, of course, except for Alphabet over here. And even though it has a really huge P ratio, it's still considered undervalued on my opinion. The next step is to understand if I can buy those company with my broker, that is the Interactive Brokers, and then I will start to build my portfolio. For the portfolio build, it's really important to take in consideration where the company works, so in which industry, and also the currency that we are talking about, because as you can see, we have dollar, Canadian dollar, euro, so we have to build a good and balanced portfolio. Even though I don't consider Logista Integral and Lululemon Athletica really cheap, I have always to consider them as a qualitative companies that have a stable and good growth over time, and those are good companies, for example, for my portfolio. Okay, so this is my final portfolio. As we can see, we have a good balanced portfolio, even though we have a lot of retailers that dominates my list. This is because I didn't filter by sector, I filtered by stable revenue and consistent growth. And surprisingly, of course, many retailers pass this test because they sell goods people buy regularly, even in downturns. I wanted to focus my portfolio mainly on qualitative companies, so as you can see, I'm just looking for a revenue consistency, quality fundamentals, so cash flow, margins, debt control, value orientation, buy below intrinsic value. And this is my main objective as investor. To balance the fact that there are a lot of retailers, I just added to the list that is actually also based on my score Alphabet, Logista, and Ryanair. And of course also Northwest Company, that is something that helps me balance a bit more my portfolio. So the first one, Alphabet, I use it because it's a tech growth, stable earnings, but market sensitive, and it's one of my core with strong cash flow that I need on my portfolio. Then we have Logista, is distribution, stable revenue. It's a defensive stock, and also here we have a role of core thanks to the huge cash flow that the companies generate. Regarding Puilo, it's a retail, stable demand, and core and cash flow too. So my core three main stocks are those three. Then we have Cranswick. It's a food consumer staples and it's a defensive stock. Same with Northwest Co. That is essential retail and it's stable too. And of course also AG Bar and Williams Sonoma. The AG Bar is a beverage, steady cash flow, and Williams Sonoma is a retailer discretionary but high margin quality company. The last two are TJX companies, off-price retail, resilient in downturn and quality company, and then we have Ryanair, travel, cyclical, sensitive to shocks. I put a bit more weight on Ryanair because I think that it helps me boost a bit more the returns of the investments. Based on that, also because I am someone that is capable of manage high volatility portfolio like this. Now let's have the first assumption. This is called stress test. This is an assumption where I'm going to take in consideration a recession. This first assumption is equity market minus 10% is not a really big thing. So we have a consumer discretionary slows, travel decreased slightly, and defensive sectors such as food, staples, distribution hold steady. So this is a stock situation that does not impact too much on my portfolio, and as you can see, we have a portfolio impact in total of 4%. Now let's imagine a real recession, such as the second assumption, with the equity market at minus 30%. So we have a consumer cut spending drastically, travel collapses, and tech drops sharply, but fundamentals hold. In this case, we have a portfolio impact of almost 16%. Ryanair with minus 35%. Those are really huge number, of course, but are not something that I'm scared of because I know how to control volatility also under psychological point of view. I conducted my analysis and I'm ready to take on this investment for this year. Okay guys, this is my portfolio for 2026, and what I do now is basically put on my calendar when there will be any kind of earnings or dividends, so I will know and I will check if my broker is actually reinvesting everything that I will get from this portfolio. I will check it not every day. I will just check it one time per month. Check it too much is not good, also from a psychological point of view. And since this is a portfolio that is based on value investing strategy, this case you don't really care about macro trends. You just care about what the company is doing, how they are going, and what's their annual report, for example. I hope that you like the video. Just leave a like and subscribe so you will not miss any kind of video.